last year was a down year in terms of volume. The year before was a down year in terms of volume too. So, the industry is kind of trying to figure out if there's something wrong, okay, or what's going on, because we had some, such incredible growth, since 2000, right? So, it feels a little bit like we stalled out, around 4 billion contracts a year, which is a lot of volume, but the growth is not there, and people are trying to figure out what's going on. To see volume, pretty strong with a VIX of 11 or 12, it doesn't worry me for volume, because really, everybody keeps waiting for the other shoe to drop in terms of geopolitical risks or whatever, and we're still waiting, but volatility will pick up. We're looking at the institutional participants. We source data from the SEC, and there's disclosures, and we basically data mine those looking for the option positions. And every quarter, we can see how many institutions are reporting holdings in options, and that has a very steady uptrend. So, and it's nice and steady, actually. It's nearly 100 new accounts showing up a year, and about 85 to 90 dropping off a year. So, in addition to participation, which I think is healthy, a lot of the growth has been in complex order activity, which these multi-leg spreads, and that's coming from the fact that these exchanges, and this is, to me, this is the very healthy part of these exchanges competing with each other, is they're innovating in building these complex order books, right, which will let you, instead of having to leg a butterfly by buying one and selling two and buying another one and doing it all on the screen or through a voice broker, it actually goes into an order book designed to execute strategies like that. And now I think they go up to 10 legs. And the exchanges have built these safety speed bumps, which are parameterized into the trading engine so that there's no way you're going to get lifted on 10 of your offers at the same time. And now, with these exchanges with the operators running a bunch of exchanges, you have the ability to do cross-exchange speed bumps, which is pretty cool. And it's one benefit of 5 operators with 15 exchanges. That's another positive, is because it improves the quality of the market. It kind of builds confidence of the market makers. They're not going to get run over and be out of business one day. There are challenges, there are problems, right? And seeing markets widen out over the last few years is not a healthy thing to see. And what you get in this concept of a two-tiered market, where you have your shown quote might be 50 cents at $2, but the tradable market that you can't see, but if you put in a market order to buy, you're not going to pay $2. You're probably going to pay $1.15, because it'll go into an auction process. If an exchange says, well, we're going to take the high ground and we're going to streamline this, and it's going to be it's super simple, and we're not going to have auctions. And I'm not actually saying that auctions are so bad that they should be eliminated, but I think they should be limited more than they are. That the other exchanges are going to say, well, that's fine, because we're going to keep doing it, because there are certain participants that like the auctions as is. So it is something that it kind of has to be handed down from higher up. For several years, we've been saying, it's a great time to be a customer for options, because although you have kind of some widening out of markets and the less liquid stuff, when you kind of focus on where the volume is, which is these hyper liquid things like SPY and Apple and Facebook, and especially in the shorter term options, where the data showed 80% of the option volumes in 150 names, 3% of the names. Of that, about 40% is in short-term options, things expiring within 2 weeks. Okay, so it's all in the front end, and those options are a penny or two wide. Okay, and commissions are as low as they've ever been for most retail, and if they're not, you should find a broker that is competitive. And it's a great time to be a customer. The tools are getting better, so. And it might be one reason that we have lost some market makers, is because it's actually the scale tipped. If you're enjoying nice tools, for almost no cost, and tight markets in the liquid names, that's a great time to be a customer.